What's going on, everybody? So today, more bad news across the board. Unless you're trying to maybe buy a home, this might actually benefit you a little bit. We'll see. But it says weekly mortgage demand from home buyers tumbles 12% as the higher interest rates take their toll. It's kind of exactly what we expected to happen. Higher interest rates means that higher payments means that your price point to buy a home if you weren't already pre-approved at a certain interest rate, is now much higher, and now you unprice yourself out of a certain home. So, if, for example, you were looking for a $600,000 to $700,000 home at 3% interest, maybe now you can only get into a $500,000 home at 5.5% interest for that same monthly payment. So the key points here, summary, we got the average contract rates for 30-year fixed rate mortgages with conforming loan balances of $647,200 or less, decreased to 5.49% from 5.53%, so a decrease of 0.04%, really insignificant. But needless to say, it's to kind of stabilize that rate, right? It's kind of basically just saying we're right around 5.5%, right? Mortgage applications to purchase a home fell 12% week to week and are 15% lower compared to the same week 1 year ago. And applications to refinance a home loan continued their landslide, falling over 10%. Housing, I live in Florida, it's been absolutely insane. I'm sure it is that same way everywhere. I have not been everywhere to validate that, but I'm pretty sure from what I've read and seen, it's pretty across the board. Everybody's just there's no supply there. So mortgage rates actually fell slightly last week. The damage has already been done to housing affordability. Both refinance and purchase loan demand dropped, pulling total mortgage application volume down 11% for the week. And mortgage applications to purchase a home declined 12%. The first weekly drop in home buyer demand since third week of that. What I found was interesting. As I was looking at the refinance stuff, which I was actually wondering if that was kind of created this. These are the mortgage rates. I'm sorry, this is the refinances. This is kind of our trends in refinancing, and now this chart goes only to like basically Q1 of 2020. I did find another one, but Adam only gives you the information. Basically, this is Q4 right here of 2021, so it does not yet have Q1 of 2022 yet. But if you kind of look at this chart and you look through these the refinances, so if you actually look, this dark blue line is people that are purchasing homes, not refinancing, just purchasing. So steady increases since basically this is 2008. People are buying homes, crash, boom, 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 kind of came up. Now in the last few years, we've had quite a bit of an increase in terms of dollars, but I mean, prices also increased too. So I mean, maybe not necessarily. They maybe don't necessarily have an increase in the amount of homes that are purchased, but the amount they cost is going up. And it's very similar to right here. What did we have? One, two, three, four, five, six before we crashed. I mean, or at least before the peak. I think the crash was more of over in here. That's when everything started to kind of shifting back down. Once we came up, we came down. That's when we had this recession here. So I'm curious to see what one, two, three, four, five. We kind of in that range. But as you can see, refinances, people that refinance. So when you go to refinance your home, you've got many options. You can do a cash out refi, which means you take extra cash out of your home, and that's tax free because the government sees it as a loan and not as income. You could also just refinance your loan for what you owe left on it to reduce your payments and all sorts of other things that you can do with refinancing. But there's a reason to do it. A lot of the times, it's either to get cash on hand or to reduce your monthly payments. And most people, I think, do it for monthly payment reductions. Now, what I did find interesting, different from this time back in 2004, 2008, is if you look at the HELOCs, look at these HELOCs on this chart here. So yeah, we did have the home purchase increases, which is very similar to what we received here. We had a lot of refinances. This refinancing, I mean, if you look at these charts here, this refinancing almost pretty much makes up most of the chart back in 2004 to 2006, which we know how that ended. But look at the number of HELOCs here that we have, which is home equity lines of credit. So people taking out basically using their home as a credit card. Take out a HELOC, you can fix it, but then you start paying interest on that, and you start paying that payment. And a refinance, typically what you're doing is you're basically redoing your mortgage, and then you have your fixed payment, and maybe your payment goes up by like 100 to 150 bucks. a month, or maybe it goes down by that amount. In a HELOC, basically it's like they give you a credit card for whatever you've been approved on. Let's say it's $50,000. You go out and put a new pool in your house, and then now you're paying on that $50,000. But you pay that off, it goes away, back and forth. It's very similar to a credit card um, in the way that it kind of functions in being able to pull money in and out. Well, I'm sorry. I did not get a lot of sleep last night. I apologize for yawning there. But as you can see, we did not have a lot of HELOCs, which is actually surprised me because I would have thought more people would have been pulling money out. And in this case, I start thinking, okay, well, what if they're pulling money out via the refinance process and using that money to go buy a second house? Let's just say you bought a house in 2015 for 400,000, and it's not uncommon that that house could be worth 1.2 million dollars in 2021, just based on the spike. And what if you did a home equity? What if you refinanced your home? Uh, and they'll give you about 75% of the value, or kind of, let's just say you did it for 800,000. It gives you an extra $400,000 in cash, and maybe you got your own little savings, plus you paid down some of that mortgage too. So let's say you get $400,000 in cash from refinancing your home. You can go down to another state, go these other states here, Florida and such, and you could buy a pretty decent house for $400,000, or at least you could, and you could have bought that thing cash. And if you get foreclosed on the house you just refinance on, big deal. You get foreclosed on, big whoop. You got your other house down here that you can fall back on that you own. Now depends if you go bankrupt and stuff like that. There's more complicated matters in that proceeding. But if you just get foreclosed on, sorry, here you can have the house back now. I borrowed my money, I'm out, and use that bank's money to buy your house cash. Now you own it. It's a good fallback plan, but it's kind of risky, and maybe that's kind of where all this extra excess cash came from, because there's a lot of cash buyers. Of course, obviously the stock market went insane. But what I actually was also looking at too is the average. To continue the article, it says the average contract interest rate for 30-year fixed went from 5.4 to 5.5, increasing a little bit for loans with 20% down. So that doesn't mean that's you probably, this is great credit, 20% down, really no complications on the home or whatever like that. Most everybody else is going to probably get higher than that. They always like to give you the juicy, it's not as bad as you think. I mean, but this is like the 1% of people in the, home buying process, right? So, they never like to compare to the 1% unless they're trying to make things look better than what they actually are. It says inflation isn't helping consumers feel particularly flush. But I did want to say about the 5.5% rate. If you actually do look historically, rates are way lower than they've ever been, even at 5.5%. You go back to maybe 2009, 11. I know when I bought my homes in 2011, it was like 4.7 and 4.5% is when I bought them. But that being said, the prices were astronomically lower. For example, when I bought my home in 2000, well, one of my homes in 2011, I bought it for $80,000, 88,000, sorry, $88,000. I bought my home for, but it had recently sold back in 2007, right in the peak time here, for $400,000. So the house price basically dropped by 75%. Is insane. So I got a great deal on the home, and at a 4.75% interest rate, which is fine because the price was reflective of that. Right now, you've got these interest rates that are now back up to the 2011 range, right where I was at when I was buying my home. The prices, though, haven't changed to accommodate that, right? So, I mean, that's kind of where you're at in this world, and that's where, like, I know housing prices tend to lag. So that's kind of in terms of not lag, but they're slower to fall than most things. But we will see. The problem we don't have is that we had back then is a massive supply. There's not a huge supply of homes at this moment. If I go to my regular MLS, I will see. ah, I won't see any foreclosures. Which actually, I will show it to you. Here's our MLS for my county. And if you actually go through, this is the public MLS. This is the one that the realtors use and everything like that. It's open to anybody else. I live in Brevard County, Florida, and accept cookies. And if you go here, to advanced search options, and you look, there are 914 homes for sale in Brevard County. Now, this number on a normal trend when normal homes back in 2018-19, this is up to 3,500, 4,000 homes available. Here we are at 900. Now you go to foreclosures, which you can do a filter on. Property type. It's not there. More filter. Sorry, that's where it's at. And then we go to distressed. And just say that you want to look at, let's see, oh, sorry, of course it's going to do that. Distressed, and you want to look at short sales. No, I don't want to sign up. No short sales, right? Because before, usually, not every time, but before a home gets foreclosed on, it will try to short sale so that it can recoup some of that money with an agreement with the bank before ruining people's credit. So there is one house in Florida where I live in Brevard County here, where they launched the shuttle up in this area. There's one foreclosure. I've only ever bought foreclosures. That's just pretty much my thing. I like to get a deal. This is a terror. This is not a great place. I would not live in this area at all. I know this area, and I would not live over there. And look at that. I mean, it's $171,000 for this house. I mean, it's a 1,200 square feet. If you know anything about Florida and that is absolutely ridiculous. This is just insanity. So that's kind of it. I mean, where are all the foreclosures at? Well, I mean, they had them paused. So there's that piece of supply that doesn't exist right now. I mean, there's a piece of there's a piece of supply. I mean, you got new houses create supply, you've got sellers that create supply, and you've got foreclosures. And if you got no foreclosures and the new builders can't build as much and prices are going up for new builders, that basically means that they're building six to $800,000 homes. Okay, that's great for people that can afford $600,000 to $800,000 homes, but not a lot of people can afford that. The bulk of your people are going to be the middle class. Those are the bulk of going to be your purchasers, right? Well, if you're pricing out the middle class, which I don't know, I mean, the average salary of a middle class worker probably somewhere in the $50,000 to $80,000 range, I'd say, is probably the median income. And in other areas, there's poorer and wealthier, right? So if you can only build a home for 600 to 700,000, but somebody that is in the middle class can't afford 600 to 700,000, there's really no reason to build homes anymore, right? I mean, you're not going to sell them to anybody. I saw an article the other day talking about that. Basically, they were talking about how people are now trying to get out of the homes that they requested to be built because the building costs continue to rise while the house is going up, and they're not going to be able to afford it with the interest rates. It's kind of insane. So here we are to continue the article. It's the general uncertainty about the near-term economic outlook as well as the stock market volatility may be causing some households to delay their home search. Applications to refinance a home continued their landslide, falling another 10%. Yeah, because you're not going to refinance at a higher rate than you've been able to, like, if we go back to this chart. I mean, if you look at, mortgage rates. If you look at it, if this is where we are, you have a higher rate. Your mortgage is currently at a higher rate unless you bought your home back in 2010. It was only at that point, if you hadn't refinanced in any of these lows, you probably ain't going to do it. So, so that's where we're kind of sitting. It says 2 years of record low interest rates during COVID enticed a refinance boom, which has now gone bust. There is simply a very small pool of borrowers who can now benefit from a refinance. Exactly what I was saying. Is that then so while dropping very slightly from the week before, the adjustable rate mortgage share of total applicants remained high at 10.5%. So it was around 3% to start this year. ARMs offer lower interest rates to be fixed for a rate for up to 10 years. That's dangerous, though. So adjustable rate mortgages do offer lower rates. I know recently somewhere around like 4.75 in comparison to this 5.5. Was the rate you would get for adjustable. But, you can get them fixed for 5 to 10 years, right? And the problem you run into is, what if these rates continue to rise? What if these rates don't go down? What if they keep them higher? So what if your mortgage rate, like we go back in time and we look at mortgage rates again, it's all hunky-dory to get an adjustable rate mortgage when mortgage rates, and I'm sure that they're probably telling you, oh, they always go down. Look at it. Mortgage rates always go down. Look at that. Look at this chart. It's always going down. And You know what? It tends to. But what if you adjust? What if your mortgage rates can always go down, right? And you're here, and then all of a sudden, boom! This is when in 1994 or five or whatever year this is. This is when your adjustable rate mortgage adjusts here, not here. Well, that sucks. That sucks bad, right? That's awful. That's 9% versus 7%, and maybe okay, maybe it's better for you than it was here, but it's not that great. Not that great, right? And now, if you're in the opposite trend, which is what if this is the start of something like this right down here? Because this is what occurred when they were trying to fight inflation back in the 70s. They had to raise mortgage rates to massive, not only 16, 17, 18. That's like credit card rates. So what if you get an adjustable rate in mortgage here and you say, okay, yeah, I'll do this, and it adjusts every 5 years or 10 years, right? Well, 5 years from 1971, 72, here you are. Boom, you went from 6.5%, let's say 7% to now 8.5%. Oh, okay. Well, I mean, I can afford that a little bit. I'm sure the prices of everything isn't going up. Well, obviously, during this period of time, there was massive inflation, the biggest inflation we've had except for now. So your mortgage rate was going up at the same time the cost of everything you bought was going up. So I wouldn't be surprised. I haven't looked at the data myself to see the foreclosures massive skyrocketing in this range, unless the government came out with some sort of can't foreclose on people thing. I would expect to see that. I have not looked at that data, just to guess on my part. Um, but then okay, well we're good. We can handle this percentage increase or whatever. We're solid. But then 5 years later, it adjusts again. So from 75 up to 80, now 1980. Boom, now you're at 12 to 12.5%. Boom, adjust again 5 years after that, 1980 to 85. Okay, well now you're at 14.5%. I mean, the fact how much your payment would go up, your mortgage payment, this is catastrophic to you. Unless you're just making mad money and you continue to make massive money, I don't see this being beneficial really to anybody. It's very risky for 0.75%. And if you really can't afford to do it on a fixed mortgage, I don't know if it makes a lot of sense. Well, if it makes sense to you, it makes sense to you. I mean, to me, it doesn't make a lot of sense, but I think that you do what you'd wish to do. Everybody has their own level of risk. And my level of risk is knowing that 100% of the time that's what's going to happen, because insurance and property taxes go up. Those things will continue to rise on you. It's not like they're turning those things down at any point in the time in the future. And once they have a valuation on your home and they increase property taxes, they don't tend to reverse that and drop property taxes. They can, but it's not really common place. So. That being said, guys, I just want to kind of review this stuff with you guys. Look over this article. If you are trying to buy a home, I have been trying to buy a home since COVID started, and it has been an awful experience for myself and my wife. A lot of disappointment, and just not really looking, not really what you were expecting. Because I bought quite a bit of homes in the past, and it's been really easy. This has been very challenging experience. I'm sure you guys have also, if you're trying to buy a home, have had experienced that challenge. And now we're sitting here going, well, now we don't want to buy a house. Just wait for the housing prices to crash, and then I'll just get a cheaper house, even if it's at a higher interest rate. It doesn't bother me. I paid a higher interest rate before, 4.5%, 5%, but I got my house for under $100,000, which now my mortgage payment's like ridiculously cheap in comparison to how much income I earn. My mortgage payment's $550 a month. It's absolutely ridiculous. And I almost have my house paid off now, just because my wife and I threw more money at it because the payment was, like I said, $550 a month. At one point, my payment was cheaper than my car payment. So it's funny. Granted, I know it's different years of term, 5 years versus 30. But that being said, I'm curious to see if you guys had any other experiences with this. If this is discouraging to you, if this is hopeful to you, maybe if you're trying to buy a house, the prices are going to go down and you don't have 30 offers with 10 cash offers sitting in line with you as you go to look at an open house with another 40 cars waiting in line to just walk in like you're going to a slaughterhouse. So I'm curious if you've had similar experiences. If you did, let me know in the comments. I appreciate it, and I appreciate you tuning in. Thank you.